But now let's me welcome Mayuresh Joshi, the fund manager from Angel Broking, to the show. Mayuresh, good morning. And let me first ask you, power stocks, is there anything which you like in that? How the valuation is looking? If I look at a couple of stocks like Tata Power has recently gone to the lower end of the traditional range, 65-70. If I look at REC, PFC, the financing stocks, very stellar outperformers over the last 2 to 3 months. So financing stocks are outperforming. Then you have mixed trends coming from the power producing stocks. So anything which you like in the power space?
So morning, Piyush. I think the entire sector, if you look at the value chain for the power sector as a whole, whether you're talking about generators, the distributors, the transmission players, and the EPC players, I think they've got going through stressful times. Because of the financial duress that the SEBs were probably undergoing. You also had a lot of volatility as far as the end realization rates are concerned. Merchant rates in the near term have moved up, but again I think the input costs in terms of generating what is probably required to get generated was probably on the higher side, which were curtailing their margins as well. For the transmission players, again I think to maintain the regulated ROEs, to maintain their pace of capitalization over capex was extremely essential to have that 15.5% generated. And again, I think the expectations in terms of how renewables shapes up is clearly going to be a defining trend going forward. So again, I think a large element in terms of this entire value chain moving. My own sense is that with some resolutions happening, you've probably seen a court order probably justifying that rate increases can probably happen in specific UMPP plants based out of Gujarat, like Mundra, and that probably has a say in terms of curtailing losses of power companies operating out of that area. So I think you have to be a little bit more specific within the sector itself at this point of time. Tata Power is something that we continue owning in our funds. Our entire thesis remains the same. I think the losses probably for the Mundra plant probably getting curtailed at this point of time. The regulated assets both at Delhi and Mumbai I think are at stable levels. The coal assets and the coal business thereof have seen some pressure points that might continue at least for a quarter or two in terms of at least the Indonesian policy going ahead. What you've probably seen in terms of realizations also at the lower end. But I think a large element in terms of how the stack-up probably happens, I think we still own Tata Power as a clear disclaimer in our funds.
For today. But coming back to you, Mayuresh, whether it's footwear stocks or we're talking about the gold stocks, those actually are seeing some strong gains. I discussed the power with you. Another fundamental theme, whether it's the gold jewelry or the footwear stocks, how much valuation gap is still left? How much opportunity is still left for the investors, again, if somebody wanted to lap up stocks?
No, so Piyush, I think there are two elements here. I think how you're probably stacking up the earnings profile for these companies over the next couple of years, assuming what they've probably delivered over the past 1 year. And the second element, obviously, in terms of the historical performance, what kind of a valuation stack-up does happen with considering both these points. Now, for footwear or gold companies, I think when you're probably talking about the kind of accretion that they've probably done, I think there has been a huge amount of value addition that has probably come through. And there are expectations that as the e-tailing bills probably starts coming through, you're probably expected to see more gains coming in from the unorganized sector. So the unorganized sector, specifically for a sector like gold, for example, I think it's a huge opportunity out there. Even the footwear players, I think, as more and more unorganized players start coming into the ambit over the next few quarters, as compliance increases, I think the organized players are going to benefit. And with the benefit below 1,000 odd rupees, below 500 odd rupees in terms of lower GST rates, I think the competitive intensity obviously lies in favor of the organized players. Having said that, again, I think you did see some amount of margin compression for a few of the footwear players. Even for the gold companies, you've probably seen some amount of stickiness happening as far as demand is concerned. But the expectations largely are that demand should normalize. And as that happens, I think both these elements create the leverage that one probably looks at the balance sheet. Considering the fundamental aspects, I think if one probably looks at valuations, a few of the stocks that have moved up significantly, probably at the higher end of the range. So I think one really needs to adopt a stock-specific approach here. But as I said, I think the opportunities for these sectors probably are pretty huge over the next 3 to 4 years.
Thanks a lot, gentlemen. Mayuresh, Manav, Gaurav, Jay, for all your insights on the markets and the stocks at present. We'll take a short break, but stay tuned. As we return from the break, we are going to connect